This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this update is Masa Takeda, manager of the Hennessy Japan Fund. Let's jump right in and get your thoughts on something that has been on everybody's mind recently, and that's tariffs. How are you approaching tariffs as a portfolio manager, and what are the potential spillover effects that people may not be considering?
Okay, so I will paraphrase this a little bit and discuss the potential impact on our portfolio. So in our strategy, we are predominantly invested in companies with significant international growth opportunities. So for that reason, our portfolio is exposed to the U.S. economy. Now, we don't worry too much about the upcoming U.S. tariffs because our portfolio companies are in either non-manufacturing businesses with strong pricing power, or manufacturing businesses with complete value chain established within the U.S. So, for example, non-manufacturing businesses, we have Recruit Holdings, which is an internet company. They famously own Indeed, which is the world's largest online recruitment platform. Sony is another example. They have the PlayStation franchise, as well as music and movie business. These are reasonably insulated from tariff risks. In terms of manufacturing businesses, they will be eventually subject to U.S. tariffs. But Keyence, as an example, one of our longest holdings, they make highly value-added, high-margin products. They develop customized factory automation sensors that help industrial customers save costs by replacing human workers. And so the demand for their products will remain robust. The customers will find their offerings valuable. Hitachi is another example. Due to rising power demand for AI, power grid solutions have been becoming increasingly important, and Hitachi has a wide array of products that cater to this need. And then lastly, manufacturing businesses with complete value chain within the U.S. Shin-Etsu Chemical, their PVC business, the bulk petrochemical product, they have excellent track record in this space, and they have production bases and whole supply chain established for many years mainly in Texas and Louisiana. So we think our portfolio is well positioned.
Masa, how has the recent volatility in the U.S. markets impacted the Japanese market?
So the volatility in the U.S. has had some repercussions on the market, but I think the market has largely been calm, and the economy also remains on track for growth. Now, in terms of market news, I think one piece of good news recently in Japan was Berkshire Hathaway's announcement, the disclosure of their holdings in 5 Japanese trading houses. They raised their holdings in those names, one of which is Mitsubishi Corporation. And we have been invested in Mitsubishi Corporation for a lot longer than Mr. Buffett. As we understand, Berkshire Hathaway has been scaling back their gigantic equity portfolio in the U.S., such as Apple or Bank of America, possibly on valuation concerns, but he's been actually doubling down on Japan. So I think it's a huge vote of confidence for Japanese stock market. Outside of trading houses, I think there's other interesting names within the broader financial space that might be of interest to him, such as Tokyo Marine. It's one of the largest, it is the largest non-life P&C insurance underwriter. Together with MS&AD and Sompo, there are three mega insurance groups, and there are only three mega insurance groups left in Japan, and between them, they control about 90% of the market share. It's a very cash flow generated business, strong underwriting track record, and with that, they are now globalizing their businesses. Orix is another one. It's a financial services company, and it's also an investment company. So they have crown jewel assets like Kansai International Airport, which is a monopoly. They are the third largest aircraft leasing business, and they also have hotel operations and own property assets that are currently benefiting from the booming inbound tourism in Japan. They also have leasing business, banking business, life insurance business, all of which are going to benefit from continued interest rate hikes in Japan. Despite all these positive trends, Orix is trading at extremely attractive valuations of price to book less than 1 times, less than 10 times PE multiples, and dividend yield of more than 4%.
So, Masa, we're recording this in March of 2025. And with the yen appreciating right now, how is that impacting your portfolio decisions?
So, yes, the yen has appreciated in recent weeks or months, but the extent of appreciation has not been that significant. And the other thing is Japan used to be currency sensitive economy because it was an export powerhouse. But over the years, corporate Japan has been making the effort to become more and more currency resistant. And for our portfolio, in my opinion, we're actually naturally hedged in terms of currency risks. And what I mean by that is, for dollar-based investors, if the yen depreciates, the dollar-based returns on equities will be reduced. But this depreciation actually enhances the international competitiveness of the businesses we own. So our investors are actually compensated by this. And on the other hand, if the yen appreciates, it will enhance the dollar-based returns on equities immediately, while hurting the international competitiveness of the businesses. But we carefully select high-quality companies run by smart management teams. They know how to deal with these issues. For example, shifting production overseas, matching revenue and cost of goods within the same currency to align currency exposure, or by simply focusing on high quality, high margin products. So we don't really worry about currency risks as well.
Well, as a follow-up question to that, do you think the yen carry trade is over?
So considering the fact that the Japanese yen is pretty much the only currency today with wide negative real interest rate. So that creates interest rate differentials with other currencies. So I'm leaning towards continued relative weakness of the Japanese yen against major currencies. In other words, for better or worse, the yen will likely remain as a funding currency for carry trades in the future. And for that reason, we don't expect the yen to strengthen to the levels we saw back in, for example, late 1990s or between 2009 and 2012, when the exchange rate shot up to 80 yen to the dollar. There will be volatility from time to time, but we use it to our advantage. We can buy our high conviction names when we spot severe mispricings, dislocations on the market.
So, Masa, we've been doing these recordings for a couple of years now, and we've discussed Seven and I multiple times. They've been making some headlines here recently, and things are getting interesting for the company. What is your take on the situation?
Last year in September, we published our investor letter expressing our optimistic view on this position, saying, we are indifferent to the eventual outcome of the ongoing merger talks. And even after the recent withdrawal of the MBO offer by the Ito family, the founding family, and the share price fell after the news, our optimistic view actually remains unchanged. And there are two reasons for this. One is the merger offer from Couche-Tard still very much remains as a valid option. So their offer price of $18.19 per share is significantly higher than the current share price. And we are fully aware that there are several regulatory hurdles, but we think it's not insurmountable. So, these issues can be addressed by making adjustments to the current deal structure. The second reason is even if there's no merger, we feel that the current management, since 2022 proxy fight, the management has been under close public scrutiny. So there's a tremendous pressure on the management team. There's an elevated sense of urgency and crisis. So we expect management execution to accelerate going forward. Now, if you look at the U.S. convenience store industry, it's a very fragmented industry. So there's scope for long-term market share gains through roll-ups as well as organic growth. And then outside of the U.S., outside of Japan, there are still a lot of untapped market opportunities. And these potentials are not at all reflected in valuations proposed by Couche-Tard. So we may actually, get far greater returns longer term, by having the patience rather than crystallizing short-term profits through an acquisition. And then in terms of margin of safety, now last year's event has shown to the world that there is value in Seven and I. In Couche-Tard alone, they've been pretty persistent. The first merger attempt, 2005. The second one was 2020, and now 2024. Without Couche-Tard, I'm sure there are many interested parties, whether it's strategic buyers or financial buyers. So I think there's a solid floor on the share price. So we are very optimistic on this position.
So last fall, you had an appearance on CNBC, and you discussed how Japan is coming out of a decades-long deflation. How has the country turned this around?
So core CPI, excluding energy and food, has been trending above 2% for more than 2 years, since 2022. So I think we can safely say that Japan is out of deflation. Now, there are significant implications for the Japanese economy. One is consumer psychology change. So under deflation, households hold back from making new purchases, hoping that prices will be lower over time, which is bad for the economy. But during inflation, the logical behavior for households is to spend money sooner than later, which is good for the economy. So the velocity of money should pick up moving forward. The second point is the value of yen will decline during inflation. There's about 2,200 trillion yen in household liquid financial assets. There's a lot of surplus wealth in Japan. That's about $15 trillion, half of which is sitting in bank accounts earning zero interest. And so we can expect households to start reallocating this surplus wealth from savings to investments in order to avoid purchasing power erosion. So, there will be strong capital inflows into the stock market. Now, the caveat is real wage growth has not kept pace with inflation. So real wage growth has been in negative territory. But for reasons I will explain later, we are optimistic that real wage growth will turn positive on a more consistent base going forward. On a more positive note, the current inflation is leading to higher interest rates in Japan. And, for every 10 basis point increase in bank savings rates, now that produces about 1 trillion yen additional household interest income. And that's about 17 basis points of Japanese GDP. So having high interest rates can actually be stimulative to the economy, contrary to common narrative.
Yeah, that definitely is contrary. Interesting. So the spring wage negotiation season is almost here in Japan. For those of us not familiar with this, how does it work and what are the potential implications?
Spring negotiation season, the traditional annual negotiation, in Japanese it's called shunto, and it literally means spring battle. But the fact of the matter is this is organized collective wage negotiations between leading labor unions and their employers across Japan, held during spring season. And the outcomes from these negotiations affect not only the workers directly involved, but also it sets the trend for the rest of the economy. So these are very, very important events in Japan. During the between early 1990s and 2021, 2022, Japan had no real wage growth. And during that time, the US and Europe, they saw their real wage grow by about 50% cumulatively. So real wage growth has been flat in Japan, but over the last few years, labor unions have been scoring huge wins. So 2 years ago, average base salary increases were in the high 3% range. Last year, it was about 4 to 5%. And this year, we're looking at similar levels, if not higher. So things are looking very encouraging now.
So Masa, as you look at the marketplace today, what is the bull case for Japan going forward?
So I highlighted several positive structural changes that are happening in Japan at the moment. First and foremost, it's the corporate governance reforms. It's been in progress since 2014, 2015, but it has only become more visible to the world in the last few years. Japan is finally embracing, shareholder-oriented capitalism. The country has also moved from deflation to inflation, normalization of interest rates, the booming inbound tourism, which is not a small part of GDP, and then also robust foreign direct investments going into Japan. Now, despite all these positive changes, the stock market has not reflected this in valuation. So we're still trading at 14 times, 15 times forward earnings, exactly the same as 10 years ago. But I think we can expect double-digit returns from investing in Japanese stock market going forward. A simple mathematical exercise can illustrate this point. So in terms of EPS, corporate profits, we can assume profit growth rate in the low single digits, which is not particularly aggressive. And then on top of that, now that's a real growth rate, but the nominal growth rate is what matters. And under inflation, nominal growth rate should be higher than real growth rate. So we're talking about corporate EPS growth of low to mid single digits. Now, in addition to that, shareholder return policies. Thanks to the government initiatives and leadership, last year, Japanese companies paid out about 20 trillion yen in dividends, and then another 10 trillion yen in share buybacks. And that's about 2 to 3% of total market capitalization. And so going forward, we can also add those to the EPS growth. And then lastly, potential for valuation multiple expansion. 15 times for earnings may not be the cheapest in the region, but given all these structural changes and also Japan's geopolitical state of the country, it's not entirely unreasonable to expect the P multiple to go from 15 times to, let's say, 18 times in the next 5 years, and that's equivalent to another 4% CAGR. So if you add them all up, we can expect 10% plus annualized returns by investing Japanese stock market.
Masa, let's wrap up with this question. So, why is active management so crucial when investing in Japan?
Statistically, Japan has been a great place for active managers to create alpha. And so if you look over the last 5, 10, 15, or 20 years, about 1/3 of active managers have outperformed after fees. Whereas in the US, if I'm not mistaken, about 90% or more underperform. And I think we can attribute this to US being arguably the most efficient market out there, while Japan is still very much inefficient. And I think there are several reasons for this. One is the language barrier. Japanese language is not the easiest language to learn. And a lot of disclosures, a lot of information sometimes gets lost in translation. The other thing is corporate culture, in the eyes of Western investors, may look a little bit peculiar at times. That also creates inefficiencies on the market. Now, we as a bottom-up stock picker with many decades of experience, we feel that we have, we understand the inner workings of corporate Japan. We speak the language. We understand the ins and outs of Japanese companies. But at the same time, we look at Japan from a global perspective, and I think that gives us a unique edge. And I think going forward, these inefficiencies will likely to remain.
Masa, I appreciate your time for this interview once again. To learn more about Hennessy Funds, please visit hennessyfunds.com.